Hello and welcome to our discussion on investments that will help you prepare for class. It's important that you view this before class so that we can learn more together in class. This video will discuss how investments are reported on the financial statements and the three different methods of accounting for investments. When you complete this video, you will understand how investments are reported on the financial statements, the three primary reasons investments are made, and know the three different methods of accounting for investments. JCPenney invests excess cash in financial instruments to earn additional income. Please take a moment and look at the balance sheet and identify the line items related to investments. Cash and short-term investments that are expected to be sold within a year are reported as part of current assets. Other investments that are expected to be sold after 1 year are included in the other assets line item because the amount is not large enough to be reported as a separate line item. The details of this will be reported in the footnotes. Other words that you will see on a balance sheet that are related to investments are marketable securities, equity investments, and investments in affiliates. Here is the income statement for JCPenney. Interest and dividend income and gains and losses associated with investments are reported just below operating income. Take a moment and see if you can determine where on the income statement JCPenney includes income associated with investments. Items associated with investments are included in the line item net interest expense. Interest income from investments is offset with interest expense. The amount for JCPenney is not large enough to be reported as a separate line item. When this occurs, the details will be provided in the footnotes. The investing and financing sections of the cash flow statement for JCPenney is shown here. Purchases and sales of investments are reported on the cash flow statement in the investing activities section. Take a moment and note the line items associated with investments. JCPenney reports cost investments net and nets purchases and sales together because it is a very small amount. Amounts that were larger would be reported on two separate line items, one for purchases and one for sales. There are three primary reasons for investors to invest their excess cash in financial instruments such as equity, which is stock, and bonds. The first reason is to earn income from appreciation. For example, an investor may purchase 1,000 shares of Facebook common stock for $49 a share and hope to sell it for more later. The percent of ownership is so low that the investor has no influence over the decisions made at Facebook. Their only investment is to share in the appreciation of fair market value. The second reason to invest is to earn dividends or interest. Dividends are a cash return that the company pays investors. Dividends are paid on common and preferred stock at the discretion of the board of directors. Investors counting on dividend income will purchase preferred stock with a stated dividend or stock in a company with a history of consistently paying dividends. Interest is earned on debt instruments commonly referred to as bonds or other short-term loans such as certificates of deposit. The third reason to invest is to exert control over the company you invest in. Investors may purchase a large percentage of ownership if the two companies support each other in their business process, or if the investor believes they can make changes within the company to increase the profits and value of the company. Investments are generally recorded at cost. The cost of the investment includes the purchase cost plus commission. An investor purchasing 1,000 shares of Apple common stock will record the investment at the total cost of the stock plus the commission. The two primary reasons for investing is appreciation or income and to gain significant influence. Investments purchased for appreciation and income are accounted for using the cost method or the fair market value method. Investments purchased to gain significant influence are accounted for using the equity method. The method of accounting used must be consistent with the purpose of making the investment, and it also depends on the reliability of the fair market value of the investment. After viewing this video, you should now understand how investments are reported on financial statements, the three primary reasons investments are made, and the three different accounting methods used to account for investments. The three different methods of accounting for investments will be discussed in the next video. They are the cost method, the fair market value, and the equity method. Please complete the fill-in-the-blank sentences related to the overview of investments before reviewing the next video. Thank you for taking the time to be prepared for class. It is much appreciated.